Yeah, I'm not really too sure why I've started 2 minutes early, but there we go. Eager like a beaver. Good morning, Cam. Let me just post the tweet. Morning, Pauline. One sec. Right, oh, there's Mr. Brown. One sec, Mr. Brown. Hang on. Oh, God. One sec. Invite co-host. Mr. Brown. Send invite sent. Come on down, Mr. Brown.
Good morning, Ryan. Good morning, everyone.
Good morning.
You're premature this morning.
Stop it. One sec. Let me just send the tweet out, and it's live. There we go. So quickly get the legals out the way. Nothing discussed in a space and session constitutes trading or investment advice, or infers any kind of endorsement by PIQ Global Limited, Trainers PIQ or PIQ Suite, or its hosts, including Michael Brown and myself, Ryan Paisley. There we go.
Oh, indeed.
I might have had too many coffees this morning.
Well, I was going to say, dare I ask where you are? Very echoey wherever you're stationed this morning.
I'm in the house that Bitcoin built. I'm at Paul's house.
Oh, right, I see. Poor Paul.
Pardon?
I said poor Paul having to put up with you.
Well, yeah, exactly that. We had a bit of a PIQ dinner last night with our amazing product manager Ed. So hungover this morning slightly, hence too many coffees earlier on, and now I'm tripping balls. But anyway, moving on.
Indeed. Well, sadly, I don't have an option to mute Ryan, but nonetheless, we will crack on. Very good morning, everyone. I'm going to do something a little bit different this morning. I'm going to start with a story that actually I've just picked up in the last.
Everyone, get comfy.
Well, just within the last 15 minutes or so. If there's one thing, two things we like to do on this program. One is laugh at Germany quite often, and the second is to laugh at the Financial Times, because you can hear the wails of pain and emotion coming from the Financial Times newsroom, having to have had publish the following story this morning. I'll read the headline. Brexit hit to UK.
Sorry, stop. Before you do, can I just say I put that top of my things to read as well.
Oh.
Let me remove
I thought
it.
I'd get there first.
Let me remove it. You take it away, son. You take it away.
So the story in the pink paper this morning is, and I quote, "Brexit hit to UK trade less than predicted, says LSE research study." Given the FT's stance over the decade or so when we were going through the Brexit process, I'm sure they'll be making full use of the complementary mental health facilities that their employer provides them with, having had to write that article. In any case, moving back to... Sorry?
Gritted teeth.
Oh, incredibly so. In any case, moving back to yesterday and developments throughout the day, there's quite a lot to get through. Actually, it was a relatively risk-averse day in the equity complex, with the S&P 500 and the Nasdaq 100 both losing about 0.4%, and the Dow losing ground for the 9th day in a row, which is the archaic index's longest losing run since 1978, which is before even Ryan was involved in financial markets. Treasuries, meanwhile, traded relatively choppy in the morning session before gaining some ground after the retail sales figures that we had out of the United States yesterday, with yields ending the day around 1.5 basis points lower across the curve. Those retail sales figures were actually pretty much in line with expectations. Headline sales rising by 0.7% on a month-on-month basis in November, while the control group sales metric, that rose by 0.4%, bang in line with expectations. And of course, the control group metric is the figure that broadly represents the basket of goods used in the GDP release, which bodes US economic growth going forwards. The dollar was stuck around the 107 figure when you look at the dollar index for the second day in a row. Most G10s going nowhere particularly quickly as we await the final FOMC decision of the year a little bit later on today. Although we did see the pound trade a touch firmer, climbing its way back above 127 after the hotter than expected earnings data that we had out of the UK yesterday morning. Although sterling has surrendered those gains after the inflation figures that we've had out of the UK this morning, which I'll get on to a little bit later on. In terms of other bits and bobs from yesterday, then, we did have the rarest of occurrences over in Europe, which is German economic data beating consensus forecasts, and that was the ZEW
Boom.
expectations index, which came in indeed at 15.7 in December, the highest level since August, and above the top end of the forecast range. Don't worry too much though; normality has been resumed because if you look at the IFO Business Climate Index, which was also out yesterday, that fell to 84.7
Yeah.
in December, below the bottom of the forecast range and the lowest level since May of 2020, which you don't need me to remind you was not a particularly fruitful time for the German or the global economy. In terms of other bits and bobs of data that we had yesterday, Canadian CPI cooled a little more than expected in November, with prices rising by 1.9% on an annual basis, down from the 2% that we saw in October. I think Canada's probably got bigger fish to fry than worrying about a tenth of 1% on CPI at this moment in time, given the government is on the verge of collapse. And we saw US industrial production fall for the second straight month, declining by 0.1% in November. We also had supply out of the States yesterday, a 20-year auction, which stopped through the when issued yield by 1 spot. It's relatively well received, particularly when you consider that the 20-year segment is probably the most unloved part of the yield curve, despite my doppelganger having introduced that issue back in the first Trump administration. And in terms of headlines yesterday, just a couple worth bearing in mind. The first is that Barclays, they have lost a UK court challenge over the ongoing motor finance issue. For those who aren't aware, this case relates to car loan payments that were made during the 2010s. Dealers were often paid a commission by lenders for arranging those loans, but in certain cases, those commissions were being paid out of interest payments, which could have potentially inflated the costs that car buyers were paying in terms of the financing for their vehicle. Of course, this is now going through various legal challenges, and also the FCA are sniffing around as well. Auto finance, for those who aren't aware, is very, very big business here in the UK for UK banks. Lloyds are actually the UK's biggest auto loan provider, but you've also got other players in the industry. Obviously, Barclays, Close Brothers, around about 20% of their loan book is focused on motor finance, and UK lenders in aggregate, they're braced for payouts of up to 40 billion quid, depending on how further court rulings evolve in the early part of 2025. For context, if the total payout does end up around that mark, that would be pretty much as sizable as the PPI scandal, which I'm sure everyone remembers the countless number of adverts that we used to see on the television around compensation for that. So certainly one to bear in mind as we move into the start here. This is There's also two other things to consider with this. The first is that a lot of banks have either stopped or dramatically stopped lending in terms of autos entirely, or dramatically tightened their lending standards because they're obviously worried about what may happen next year. The second is, of course, UK banks having to make provisions for these potential payouts is likely to see, and obviously not trading advice, but likely to see them continuing to underperform their peers as we move through, really until this is settled. The second bit of news from yesterday, and this broke late on via the Nikkei, and this is that Honda and Nissan are apparently beginning talks to merge. Obviously, two of the largest Japanese auto firms. Honda, the news was pretty badly received on their part because there don't appear to be any immediate benefits to them from this merger. Their shares were down about 3% during Japanese trade. Nissan, on the other hand, absolutely motored higher. They were up by about 25% at one point. Obviously, Nissan have been plagued with difficulty over the last few years, so the market viewing Honda as a bit of a saviour for them. Interestingly, the company that probably holds the key to all of this is Renault, because obviously they are one of the largest shareholders in Nissan, so we will see how that develops. And last but by no means least, just to cover off...
Just on that, the reason why this merger is kind of happening is because they're both trying to protect themselves from Foxconn, because Foxconn are on a bit of a
Yes.
buying spree. Just a bit of colour.
That's very true. And there were also, I did see some rumours that they may also be looking to bring Mitsubishi into that sort of merger or alliance, so to speak. So we'll see how that one pans out. And last but by no means off, the UK inflation figures that we had out at 7 o'clock, so around about 90 minutes ago. Headline CPI rose by 2.6% on a year-on-year basis in November. That is up from the 2.3% that we saw in October, but it was in line with the pace seen by consensus estimates, although it is above the BOE's forecast, which was at 2.4%. Underlying inflation metrics were just a touch softer than expected. Core CPI at 3.5% on the year, although that is up from the 3.3% we saw in October. Services CPI at 5%, which was unchanged from the rate that we saw in October. The market, perhaps slightly counterintuitively, taking a bit of relief from those figures, basically because they weren't as bad as they could have been. So we've seen sterling soften a little bit, with cable coming back below the 127 handle as I speak. We've also seen a bit of a dovish repricing of UK rate expectations as well. Of course, still no chance of any shifts from the BOE tomorrow, but the market is now pricing in an 80% chance of a cut within the first quarter of next year. That's up from about a 68-69% chance at yesterday's close. And for now, that is it from me.
Brilliant stuff as usual, Mr. Brown. So just a few headlines from our dear friend Zach, which go into the overnight news roundup that will be sent out as soon as I've got off this chat. So firstly, in macro world, congressional leaders reached a bipartisan deal on Tuesday to keep the government funded through mid-March and provide more than 100 billion in relief to disaster victims and farmers. But the sprawling nature of the package angered some House Republicans. Quelle surprise. The US Congress is to vote in the coming days on restricting US investments in China as part of the bill, which will obviously fund through to mid-March. Basically, they're saying, look, let's pull back investment in China if we're still trying to struggle to keep our own government afloat, our economy afloat. The PBOC urged the financial institutions to guard against interest rate risks when trading in bonds, signaling discomfort among policymakers over recent frenzied buying that's helped drive yields sharply lower. So on this, Mr. Brown, interested in your thoughts, because I'm seeing the usual, what should we call them? I don't want to say pricks, but reprobates, claiming,
well, you have now.
claiming that the reason that yields in Chinese bonds are lower than the US, therefore the market's saying that China is less likely to default than the US. That's not what's happening.
Oh, for fuck's
I know,
sake.
right? Please,
I mean,
that is not what's happening.
yeah, it's ridiculous. We could sort of decompose moves in the bond market all day long, and it would be quite boring to do so. But I think the crux of the matter is that, default risk or credit risk is only one of about 15 different things that any fixed income instrument is discounting at one moment in time. What you're actually looking at is a situation where, firstly, look at where benchmark rates are. They're a lot higher in the US than they are in China. Secondly, you're looking at a situation where, particularly at the long end of government curves, the market is also pricing growth and inflation expectations. And you've got China, which is seeing growth slow and no sort of discernible signs of a recovery, at the same time as we're stuck in or very, very close to outright deflation. Whereas in the United States, you've got a likely sort of fiscal sugar rush coming early next year, which should push growth to the upside, and also upside inflation risks from tariffs as well. So, to coin a technical term, it's absolute rubbish.
I knew you would have some input on this one, which is great. ECB's Awanch said that a larger euro depreciation would cushion the growth impact from tariffs, but make it larger on inflation. Said the euro parity, that's my favorite P word. Well, one of my favorite P words. Europe would not lose much competitiveness. He sees rates landing somewhere around 2%. So on this parity, obviously we have this long-standing bet that I believe that euro dollar goes to parity before 110. And you're obviously the other side of that. Are you still saying 110? Not that it makes any difference. You're
Uh,
still going to win the
I
largest.
am. I am. I've got to admit, I didn't imagine that I'd have ECB policymakers taking the other
Well, this
side of
is it.
that.
It's a bit bizarre, right? Actually coming out in almost polling for
Very odd.
parity. But there you go. Um,
And also,
go
just on that, it's even weirder when you consider that um, of all the sort of major developed economies, the eurozone is one which is particularly exposed to currency fluctuations. So it seems odd that he would be sort of trying to incite inflation via a weaker
yeah.
currency when you're looking at relatively two-sided inflation risks anyway.
It's just
Don't quite
yeah,
get
it's
it.
just a whole. It is a very bizarre kind of piece that came out today from him. It's like I'm not really sure what he's trying to get at, other than he might be short the euro dollar.
Oh, he's Belgian, isn't he?
Oh
So
yeah,
maybe
well,
we just
we
leave
all
it
know
there.
about the Belgiums. Anyway, moving swiftly on, OPEC Plus is wary of renewed rising oil output, U.S. oil output when Trump returns to the White House. Delegates from the group said that because more oil would flow and would further erode OPEC Plus market share and hamper the producer group's efforts to support prices. This has been an ongoing story for quite a while now. It's the U.S. has become now a major exporter, and the cartel, who have been shaky at best for a while. One thing they've got is they were producing the most oil, and that's not even really the case anymore. In geopolitical news, a couple of bits for you. Iran's Revolutionary Guards have tightened their grip on the country's oil industry and control up to half the exports and generate most of Tehran's revenue that funds its proxies. Obviously, this is the proxies that are against what we see like the Western forces in Israel across the Middle East. China remains the top buyer of Iranian oil, and this is from Reuters. In equities, three headlines for you. Microsoft bought as many of, sorry, I'll start that again. Microsoft bought twice as many of NVIDIA's flagship chips as any of the largest rivals in the US and China this year. That's according to Omdia analysts. They estimate that Microsoft bought 485,000 NVIDIA Hopper chips. I don't know if Tom's listening, but that's one for him. Maybe it's not just an accounting scam that many people have been trying to talk up for a little while. Talks between Volkswagen and unions on cuts to its German operations continued through the night and into Wednesday, according to two sources familiar with the negotiations. Both sides are battling to reach a solution before Christmas. And finally, Tesla's Shanghai plant manager, Song Gang, has left the company, according to a letter he sent to staff this morning. He basically wrote a letter and said, "This is my last day. See you later, alligator," but probably in Chinese. Back to you in the studio.
Yeah, I don't speak Mandarin, but I can't imagine that "see you later, alligator"
Don't do the
translates
eyes.
particularly
Oh,
well.
God.
Oh God! Right, moving on very swiftly indeed to the day ahead, and of course, it is the final Fed day of
Woo!
2024,
What?
and dare I say it, probably the final proper trading day of 2024. I know we've got the BOJ overnight. I know we've got the BOE
That's good.
tomorrow, but the majority of people, I think, are probably going to wait until Powell is a press conference, which will be about 8:15 this evening, London time, about 3:15 in the United States, of course, and probably call it a year at that point.
Ow, and the
So
year is
do
gone.
bear in mind, indeed, that's awful.
That's my tweet
But
lined up for
do
later.
Jesus Christ. But do bear in mind that I think conditions are going to become very, very thin very, very quickly once we move past that Fed meeting a little bit later on. And actually, probably during the presser, when he gets asked that inevitable question about climate change, that's when
Yeah,
everyone will
right.
switch off. Before the Fed, though, we do have a couple of bits and bobs just to get through. At 10 this morning, we have final inflation figures from the Eurozone for November. Headline CPI that's seen unchanged, or unrevised, I should say, at 2.3%. And then at 1:30 this afternoon, we have the latest housing starts and building permits figures out of the United States. Neither of those likely to be particularly market moving. Of course, the main event comes this evening for those of us here in London at 7 o'clock, 2 o'clock on the east coast of the United States, and that is that FOMC decision. In terms of timings, the decision, the vote, the statement, and the projections are all due at 7, with Chair Powell to speak at a press conference half an hour later. quarter. The Fed funds rate, we're expecting a 25 basis point cut to the target range, which would take the Fed funds rate to 4.25% to 4.5% and result in a cumulative 100 basis points worth of easing as having been delivered throughout 2024. Of course, that rate cut, the door to that has been opened after unemployment unexpectedly rose to 4.2% in November, and after an inline CPI print at 2.7% on an annual basis. Furthermore, money markets pricing around a 94-95% chance of such a move, which actually makes it effectively a self-fulfilling prophecy. The decision to deliver a 25 basis point cut is likely to be a unanimous one among FOMC members, although there is the possibility that we do see some dissent once more. That dissent would likely come from Governor Bowman, who has been a notable hawk on the FOMC and could indeed vote for rates to remain unchanged. The Fed's guidance is likely to reiterate that they are on a path back towards neutral and that path is data dependent and that it would be possible to quicken the pace of rate cuts if the labour market were to soften, but also to slow the pace of rate cuts if data allows, opening the door to a skip at the January meeting and potentially even a pause in March as well. Commentary around the economy is likely to be broadly reflective of that issued after the November decision, noting once more that risks the dual mandate are roughly in balance, that the economy continues to expand at a solid pace, and that while inflation has made progress back towards the 2% target, price pressures do remain somewhat elevated. Of course, the Fed will also issue their quarterly summary of economic projections at this meeting, and the focus in those projections will be the dot plot. It's likely that we see a revision to the 2025 dot plot. Currently, the median expectation points to a further 100 basis points worth of cuts next year, assuming that the Fed deliver a 25 basis point cut later on today. I think we're likely to see two things there. Firstly is a tighter dispersion of the dots, i.e. the doves becoming less dovish as inflation risks begin to tilt increasingly to the upside. And secondly, potentially even the median dot moving higher by between 25 and 50 basis points. Of course, money markets pricing around 65 basis points worth of cuts from the FOMC next year. So what the Fed would really be doing there is marking to market dot plot, and a move and a hawkish revision shouldn't come as a particular surprise to market participants. Also, keep an eye on the longer run rate expectation. That is seen as a proxy for the neutral rate and also can be viewed as where the Fed think rates will fall to this cycle. Currently, that median expectation stands at around 2.75% for the longer run dot. I'd expect that to move higher to around 3%. In terms of the other projections in the SEP, they can pretty much be safely ignored. And the reason for that is because the Fed will be conditioning their forecasts on assumptions that the current fiscal policy stance will continue through 2025, 2026, and 2027, i.e. over the entire 3-year forecast horizon. We all know that that is not the case because President Trump is going to be inaugurated on the 20th of January and the fiscal stance is likely to change pretty significantly. Of course, the projections cannot and will not make any allowance for that because the Fed can only model official announced government policy and not rumor about what may happen once someone else takes office. As a result of that, the projections, while they may attract a few headlines, are going to have an incredibly short shelf life, and really I would just cast them off to one side. Chair Powell at the press conference, I think he's likely to really stick to what is now a very, very familiar script, again repeating that they are taking rates back to neutral and that the speed of that journey back to neutral will depend on how incoming economic data evolves. Powell will naturally want to build some optionality around the January meeting. Markets pricing about an 80% chance that they hold in January anyway, so again it shouldn't be too surprising to see Powell opening the door to skipping the January meeting. Overall though, Fed and Chair Powell specifically are not going to want to rock the boat too much. Everyone on this call, every market participant I speak to, and I'm sure members of the FOMC are just wanting to get the year done and go into the Christmas break. The last thing Powell is going to want to do is cause any sort of outsized market volatility or tumult at the final press conference of the year, and then have to kind of deal with that communications exercise over Christmas. So
I do think he's going to lay it on thick that kind of, we don't know what's going to happen once Trump gets in and over the, like you said, I think he's going to really, really lay on that kind of optionality,
stressing the uncertainties around the outlook.
But the thing is, I think people are going to probably, there's a very, very high chance that people read into that he's dovish, and I don't think that's how they should be reading it. I think people should genuinely be reading it at face value, which is, we don't know what's going to happen over the next 3 months. Give us a fucking break.
Yeah, do you know what? Actually, I'll go back to the script in a second. But one of the things that people, well, ish. One of the things that people do love to do with central banks is overanalyze. With the Fed at the minute, there's no need to, and actually, there's been no need to for the last year. The Fed came into this year saying, when we're confident inflation is going to 2%, we'll cut rates. Do you know what? We got to the autumn. They were confident inflation is going to 2%, and they cut rates. Exactly. They also happened to say, if we think the labour market is going to weaken, we'll cut rates aggressively. Well, you know what? They thought the labour market was going to weaken, and they cut rates aggressively. Exactly. If Powell stands up and goes, there's a lot of risks and uncertainty around the outlook, it means there's a lot of risk and uncertainty around the outlook.
I actually said to the guys that Friday fix that we do last Friday, I was like, I know everyone likes to take a big old shit on central banks, but the Fed are very, very fucking good at empowering, are very good at communicating exactly what they're trying to do. I think there's so much, like you said, people have just got it like in their head that they need to overanalyze central banks, and that's why they kind of put words into their mouths. If you just listen to what they're saying, they're kind of spot on, and what they're saying is correct. They are very vocal in saying, we don't know sometimes, we have to wait and stuff. And people like put so much, they rejig what's being said. But and that's why I genuinely think that we're going to see we're going to see Powell later on be kind of quite conservative and quite, hold his hands up and pretty much say, look, don't ask me to commit to anything at the moment, because why the hell should I? But I guarantee if we see that, which I think we will, I guarantee that certain people on social media and stuff, experts in inverted commas, will say that this is an extremely dovish statement or just Q&A, and it's not. It's literally just saying, look, guys, we don't ask me to make decisions for.
We don't know.
Yeah, exactly. It is. Sometimes it can be that simple.
Yes, exactly. I would fully agree with that. The one last thing I would say on the FOMC is there's inevitably going to be some journalist questions on, firstly, Trump's policies, which Powell will not be able to comment on. And secondly, there will probably be a renewed round of questioning around, if Trump asked you to resign, would you do it? Any journalist who asks those questions, in my view, just take their fucking press pass away. You're not worthy of being there. You're just trying to get clicks on the internet. Fuck off and make room for someone who knows what they're doing. Anyway, besides the FOMC, there are a couple of other things just to bear in mind. We do hear from the ECB's Lane and Muller as we move through the day today. Maybe they'll give us their views on the euro as well. Other economic data at 9:45 tonight, if anyone cares about it. We've got GDP figures out of New Zealand. That is likely actually to confirm a technical recession in New Zealand, with a second straight quarter-on-quarter contraction likely to have taken place in the third quarter. And last but by no means least, again, one for Tom Talks Cars if he's here. After the market closed tonight, we get earnings from Micron. Of course, I would expect expectations for those earnings to be relatively high. Nvidia delivered strong results a month or so ago. Broadcom delivered a very, very solid report last week. So I think people will be looking for Micron to continue that sort of positive vibe around the chip sector when we hear their numbers, which I think are due at about 9:05 London time this evening.
Oh, sorry, I was watching
and that's your lot.
I was watching a squirrel out the window. Sorry. What day is this? Wednesday. Yeah. Okay. Yeah. Cool. Mr. Brown, thank you so much for all of that. Exquisite as usual. Listeners, take care if you are trading today. If you are trading around FOMC as usual, please, please, please keep it tight. It's very, very easy to do your year in the last couple of weeks of the trading year. You won't make your year in the final few weeks. So take care, be safe, and we will see you tomorrow.
We will
See
indeed.
you later, alligator.
Bye.